So, what do the wealthy do? They do stuff like what you're doing right now. They talk to their friends, their family, and experts about money. They talk about how to earn more, how to keep more, the asset protection and this tax strategy, and how to grow more, the investing. So today I'm going to focus on the grow more. That's what I do, the investing. I'll start by telling a bit about my story. So Sugo Capital started 4 years ago, but I started investing 10 years ago, and I faffed around a lot. And I made a lot of mistakes, and I did a lot of things that took me a lot of time and energy and didn't get me great results. They were single-digit returns, and I wanted double-digit returns. And so I'll talk a bit about what I found along the way. But currently, Sugo Capital, like Liz said, we connect investors to passive income opportunities. We don't talk about how to do fix and flips or Airbnbs or anything where you're really active. This is like, how do you get hands off and get that passive income and go live your life, or run your company or whatever it is you want to do. So we've acquired 24 apartment complexes via syndications and real estate funds. So that's in conjunction with investors. So that comes to about a little over 800 million in assets acquired. And I'm on the advisory board of 2 investment firms. So today we're going to talk about 15 types of investments side by side, so you can figure out which one might fit your goals. We're going to talk about the top 3 ways to make money in investing as far as what I have seen. Tons of stuff out there, right? Tons of stuff. I'm going to share my 3 favorite that I personally invest in. And we'll talk about syndications, which is the answer to how to double your money with no work. All right, so a bit about my journey as I started in single family home investing. And this is the before and after picture, which is reversed of what you would want. You would want the dump and you fix it up and you have something great. I bought a turnkey. I didn't do proper due diligence on the property management company. They put in tenants who were just leaving their second eviction cycle, put them in my place. They trashed it, didn't pay rent. It was a nightmare. I had a couple of these experiences, and they were all out of state because I'm in San Francisco. You don't want to be a landlord in this area. So I was investing out of state, and it was just like, it was the pits. It was not what I was looking for. However, I didn't stop there. And so all of you guys are great because you're here. So whatever you've been doing, you're looking to do something better, right? And that's what I continue to do. Like, okay, that wasn't the thing for me, but let me keep looking. And so I explored over 15 types of real estate investing, and I ended up in syndications. And so that's apartment complexes, hotels, and I was a passive investor in those. And then I switched over to receiving 18 to 25% annualized ROI, and I didn't have to do anything. And I was like, oh, sweet, this is way better. This is way better. And so I started this journey 4 years ago with Sugo Capital. I'm 43 now, so I started at 39. And I include that just to know, I wish I had started way sooner. My mom joined me on the journey, so she's 25 years ahead of me in when she started her journey, but she's now living a different lifestyle. I'm now living a different lifestyle. So whenever you start is the perfect time to start. All right, so it's very important because I'm going to go through next 15 different types of investing side by side, comparing them on 4 main areas. And so these are things you need to, and you've probably already done that with Scott in this mastermind, but think about your specific goals in order to determine what type of investing is right for you, right? So a single family home rental is great for some people, not great for others. Wasn't great for me. It's perfect for someone who can have a cash flowing duplex, down the street from them. So you want to think about your vision and think about, is it passive income oriented or is it net worth oriented? So some people are really looking to, hey, I want to leave a nest egg for my kids or my grandkids. I don't need more passive income, but I want to build my net worth to pass down a legacy. Some people are like, I want to quit my job and go rock climbing for the rest of my life. I want to quit in 12 months. So you really need to focus on passive income. So you're going to choose different investments for those different goals, right? Level of effort. So I'm going to show a level of effort for all these investments. And so I want you to be real with yourself, how active or passive you want to be. all of the stuff that we offer is passive. That's my favorite, but sometimes you can make more money if you're, doing the wholesaling or the fix and flipping, but then it takes a lot of your time, right? So it's actually a job. And what level of risk is palatable to you? So if you're looking to retire or you have retired, you're going to want a little bit safer, less risky investments because you don't have active income coming in to replace any losses you might endure. And then set the goal, which I think Scott's doing a great job with all of you guys. But make sure whatever goal you set around your step one, your passive income or your net worth, that you tell someone, whoever you make your investment decisions with, whether it's Scott or a coach you have, whether it's your CPA, so that their tax strategy can match your vision. I didn't tell my vision to my tax strategist, and he gave me some advice. And then 6 months later, I was like, why did you tell me to do that? I think this other option was better. And he was like, oh, I told you this because it was great for this goal. And I was like, but that's not my goal. That was my fault for not being clear with him what my goals were, which were different than, his assumptions. So you need to tell everyone what your goals are in order to get there. And I'll say, I had a dream of, I want to be financially free. And I kind of faffed around for, I don't know, it was about 5 or 6 years. And it wasn't until I sat down and I said to my husband, here's the number and here's the year that we want to hit that number. I don't know how we're going to do it. Seems impossible, but let's figure it out. When you write it down, the date and the number, whether it's a number of passive income or a net worth, write it down and tell someone then I was like, okay, now I got my butt in gear and I was able to reach it. So I want to encourage you, I won't spend my time on this, but invest like the wealthy. So the yellow in the transfer, the numbers got kind of wonky, but the yellow represents alternative investments and the green are principal residence or traditional investments. And the higher net worth bar is on the right and the lower is on the left. And so the ultra rich invest more in alternative investments than those who are not. And so is it the chicken or the egg? Is it because they have more income available or more assets available to invest, or is it because they did invest in alternatives? There's this whole shift going on in the wealth industry favoring alternative investments, actually, because the real estate syndications are outperforming the stock market and all kinds of traditional safe investments that are actually now getting negative returns for investors. And the super wealthy, they've already been investing in it, and that's why they've been holding their wealth and preserving their wealth. Okay, disclaimer, I'm about to show a whole bunch of numbers. So these are not offers. These are not actual investments that I'm trying to offer you guys. This is for educational purposes only, and it's examples that I've seen in the past out of actual investments. Okay. So I'm going to jump a little quick through this. Actually, I'll stay here. So I'm going to have a comparison chart, and what you see on the screen now are the different columns that we're going to show. So I'm going to compare side by side the annual ROI. So that means when you exit, what's the total amount of money you made? So it's cash flow plus appreciation. So you may have an investment that you make and you get no cash flow, and then you exit and you get a chunk of money. So the annual ROI is if you take that chunk of money and you divide it by the number of years you were in it, that would be your annual ROI. Cash flow is like you get the check every month or you get the check every quarter. And so those, support different goals, right? The rest are pretty self-explanatory. Level of effort, risk. I'm going to do high, medium, low. Money needed to get started is important because everyone is probably in a different place. You may be starting with $5K to invest. You may be starting with $500K to invest. So knowing what's available to you based on where you're at is important. And hold period is particularly important if you're a passive investor. If you're an active investor, you have control over, usually you have control over your hold period, meaning when you put your money into something, when you take it out, you have control. When you're a passive investor, you don't have control over that. So you always need to be aware of what the typical is. And then for each investment, make sure you understand what it is for the investment you're putting your money into. So you're not surprised and you try to say, hey, I want to take some money out and it's not liquid. All right, so single family home rentals, you guys know what this is, so I won't go into that. I'm going to scroll down in the interest of time, and I'm going to talk about my 3 favorites. So I stopped here on Forex Trading. And so the annual ROI, so Forex Trading, can I see a show of hands? I have you guys over here or in the chat. If you know what Forex Trading is or have had experience in it, either raise your hand or put Forex in the chat. All right, we got one. Okay, so, all right, 2. Okay, so Forex is foreign exchange. And so basically it's a trading strategy that is a daily, it can be less than daily, but usually you're paying attention to it daily if you're doing it on your own, and you're trading currency basically. And so if you're doing this on your own, so it's not in a passive way, then you're on the computer, an hour or 2 a day. So I call that level of effort high because you're doing it all yourself. I say the risk is high if I'm going across the chart here, because you could make a trade or do something and you lose 50% in one day. You can also gain 50% in one day. So there are huge benefits. Cash flow, I see a huge range, kind of going back in the chart to column 2, cash flow. So how much do you receive per month or per year? It's really, I don't want to say easy, but I see a lot of people achieve 2.5% to 3% a month on the cash flow. So that's why I have 30% in there. And then if you're not taking out your money and you leave most of it in and continue trading, the annual ROI 40% is extremely conservative. You can even see it commonly up to 10% per month. So that's 120% per year. Cash needs to start. If you're doing this yourself, you can put in 5K and do this. Hold period, if you're handling it yourself, it's very liquid. So you can pull your money out, whenever you want. For us at Sugo Capital, we have a bot. So the level of effort was too much for us. And so we created an algorithm that has the same trading strategy that we've been using. And so that is one of the offerings that we have at Sugo Capital, is a fund that has a bot that trades Forex. And so in that case, if you wanted to join a fund, then the level of effort would be low. And then, we have different levels for minimum investment. So the cash need to start would change, and the hold period, there's a liquidity rules around a fund. But if you're doing it yourself, this is what it may look like. I'm going to pop through some more and stop at oil and gas. So this is another fund that we offer at Sugo Capital, and it's diversified. So it's not like one well, it's a fund. So there's multiple basins, multiple locations. And so, if you go into an investment that is diversified and you have a vetted operator, that's going to lower your risk. So like if you invest in one single family home, you have one tenant, they're out, you get no cash flow that month, you're still paying the mortgage, you have negative cash flow that month. So there's a risk there. If you buy a 10-unit small apartment complex instead for yourself, and one tenant moves out and you still have 9 there, that reduces your risk, right? And so that's similar to a fund model. So this oil and gas fund, it has multiple basins, over 200 pre-qualified sites. So it's diversified. So it reduced the risk of oil and gas. If you invest in one well, that's when it's a bit riskier in the oil and gas industry. So it is similar to, like an apartment new build where, hey, there's nothing going on, oil and gases, I'm saying. It's a piece of land, it's not producing any income, but you start in an apartment building, you start building, then you put renters in, you get the net operating income up, you get some cash flow, but then you sell it and you make a big bang on the back end. So this is similar, where there's some land, drilling, starting to produce, get some cash flow, and then when it's a proven area, then it's sold off, and that's the big bang on the back end. So the annual ROI is really strong for a lot of oil and gas deals, carbon capture deals. 75% per year annualized is common to see. And then cash flow of, 10, 12, 14% paid monthly is also common to see. So it's pretty nice for cash flow. Level of effort is low if you're in a fund because you just put your money in and you're a passive investor. Risk is high because, hey, if they use all the money and they drill all the wells and don't ever hit oil, then you lose your investment. That's why you need to make sure that they're pre-qualified sites and a great operator you're working with. Cash needed to start, usually it's around 100K when you see investments out there, and the hold period's typically 2 to 7 years, meaning you can't ask for your money back until the whole fund is ready to exit and return your capital. You don't have control of that hold period. So we do have a fund around this. These are not the exact numbers. This is more of an average of the industry that I'm showing. And next I'll talk about apartment syndications. And, if you're a passive LP investor in this. And so usually the annual ROI is 18, 20, 22%. So I put an average of 20%. Most of that comes on the back end. Cash flow, 8% is historically where it's been at. Right now, because of the debt market being crazy, we're seeing 4 to 6% on that cash flow because the cost of debt has gone up. But historically 8% is where it was and where I think we'll get back to. Level of effort, low. You don't do anything as a passive investor in those, and I'll explain the structure of how this works in a minute. And risk is low. Apartments are very recession resistant. They are, I think the name of it is an imperfect good, which is when the economy is great. Apartments are great. When the economy is bad, apartments are great. Not if you're in, and it depends on the range, right? So if you're in the luxury apartments, those are going to get hurt. If you're like a slumlord and everyone loses their job, you're going to have a hard time. But if you're in the middle, in the B asset class, that's really where people kind of move up and down, but that stays at high occupancy, usually no matter what the economy is doing. And that's what we invest in as our bread and butter and our core asset for wealth preservation. You can find all over the internet, you can find crowdfunding websites for these type of investments. We also offer these. Like I said, we've acquired 24 apartment buildings this way. Cash needed to start, you got to find, there's a range out there. Some operators take 25, some 50, some 100, and usually the hold period is 3 to 10 years. Now, other types of investments that you might have seen or explored, ATMs and the CS cash machines, they have a nice cash flow. They don't have a return of capital on the back end. So that's one of the things you want to make sure of when you're making an investment. You like the cash flow, but make sure you understand, is there return of capital at the end or not? Storage units is another type of syndication. Mobile home parks, mobile home rentals, like single family home rentals. These are all numbers. I'm going to go quickly through them and not spend too much time. But basically, medical office parks, funds, etc. How are they structured? They're structured in a syndication. And so that's what I'm really going to talk about next is, what is a syndication? What is the structure? Because I only had 2 of you who said you knew what that was. So I'll go ahead and talk about it real quick, and then we'll do an ROI calculator so you can see some of these things. So even though what I'm going to talk about is the structure for a multifamily syndication, if you love the idea of investing in like a medical office park, it'll have the same structure. If you love the idea of investing in like a mobile home fund or a storage unit fund, it can have the same exact structure. The numbers will be different, but the structure will be the same. Okay, so say I'm going to buy this apartment building for $1 million. And the down payment's 300. They don't have 300K. I would go to investors like yourself and say, hey, do you guys want to participate? I'll do all the work, but you put in the money and we'll share the profits. So who's involved? Well, we have something called the general partners and the limited partners. So what we do is we create an entity, and the LLC is the entity that owns the apartment building. So what this does, it allows you, passive investors, to be a member of the LLC, and get the income from the apartment buildings, get the tax write-off from the apartment buildings, but not have, you know, a tenant who knows who you are, who's going to come bother you about, hey, you know, tenants, toilets, termites, all that kind of stuff. So the limited partners put in the money, but they're limited partners in the LLC, so they don't have to do anything. You don't have to be on the loan. You don't have to deal with the property management company or the tenants or the taxes or anything like that. We take care of it all as the general partners of the LLC. And then for our services, then we have partial ownership as well. So there's two things we're going to look at now, the capital stack and the equity. So the capital, the money needed to make the purchase, where does it come from? So the pie represents all the money needed to make this purchase. So say we get the gray chunk, we get a loan for most of the money needed to make the purchase. And then we, you know, me and my partners, we put in the money, some of the money, but we need some more money. So we're the orange slice. Say we put in 10% of the money needed, and then we go out to passive investors and we collect 30% more of the money. And so then how do we arrange the ownership of the LLC, the ownership or the equity of the LLC? This is how we structure it. So the limited partners, those who put in the, you know, $300,000, get 70% ownership of the assets. And then we as the general partners get 30% ownership of the LLC and thus the asset. So this is really important to understand when you go looking for investments, passive investments, whether it's a fund or an apartment complex, because this 30% of the capital giving you 70% of the ownership is the key to why the returns are so nice for passive investors. Because then when we sell after the business plan's been executed, or, you know, the fund business plan has been executed that you're looking to invest in, you get 70% of the profits. And so that's really why it's such a strong exit, is because you get 70% of the profits. Now, this is an example. Sometimes it'll be a 60-40 split, sometimes a 80-20 split. So you're going to want to look for that when you're doing your due diligence and reviewing the paperwork on passive investments. But this is pretty common to see these numbers in this structure. So I'm going to pause here before moving to the next thing to ask if you guys understand the structure of a syndication, which is really typically the structure of a fund and passive investments, where there's some debt and there's some cash, and for whoever supplies the cash, they get a large percent of ownership, but in a passive position, so they don't have to do any of the work. They're not on the loan, but they still get the tax benefits from the real estate or the oil and gas or whatever it is. So either, you know, take yourself off mute and ask. I see a thumbs up. I don't see anything in chat. Oh, here we go. Here's one question in chat. Are there additional costs that limited partners have to bear? No. So that's the cool thing, is all the money is raised up front. There's a capital expenditures plan, so a remodel plan saying over the next 2 years, here's the budget we need to make all the improvements. And so we already know all the money that's needed before we make the purchase. And so all the money is raised up front. And it's not like along the way we're like, yeah, hey, there's a, you know, a leak in the roof. Oh, hey, we want to renovate 20% of the units. We would like some more money. None of that kind of stuff happens. So let's see. I'm going to jump over to the chat and just scan to see. All right. So I see Jay saying, what is the bot and how we can get involved? Getting in touch with me. Actually, if you guys want, there's a link on the screen, sugocapital.com/book a call. And that's where we get into, those are the kind of things that I really go into detail during those kind of calls. Yeah, it's like a robot. So it's a program is what it is. Okay. Oh, here's one. I thought the current administration is going green and not allowing drilling. No, drilling is definitely being allowed. We're drilling. And we hit oil twice, so we're excited. All right. Here's a question. Can you speak to due diligence in examining the GP's fee structure to see if it's reasonable or exorbitant? Management fee, acquisition fee. Yeah. Okay. So GP fee structure. So the different fees are acquisition fee. I see between 2 and 5%. And management fees, usually 2% is what I see. Sometimes 1%. I've never really seen more than 2%. So it's really between 1 and 2%. Sometimes it's 0, like we have a cash flow fund and we take 0 management fees, but we take all the upside at the exit. So, you know, I say between 0 and 3% is what you'll see for management fees. Operation fees, so that's going to be dependent on location. So Texas has different property management fees, different, it's not really an operational fee that goes to the GP. I've never seen that. I see a management fee that goes to the GP, but operation costs and expenses, huge range depending on location and market. So, you know, like Huntsville, Alabama versus San Francisco, totally different expenses, right? Disposition fee is normally around 1%. And fees for getting the loan, there's normally not a fee for getting the loan. That's usually part of the acquisition fee. Oh, sometimes there's a guarantor fee and it's like 1% or 1.5%. And so that's basically saying, you know, like, okay, we're acquiring this property for 50 million and I'm signing on the $50 million loan and I'm a guarantor with my husband on all of the properties, except for maybe a couple of them from the beginning. So I think that's the range of what we see out there. All right, any other questions on that? Okay, cool. I know you wanted to stop in about 5 minutes. So let me see from you guys, do you want me to do some examples? Go into terminology some more. I have an ROI calculator. We can plug in some numbers around money and see what that could look like with different investments. What do you guys want to do in our last 5 minutes? Nobody? Okay.
Sarah, you were going to mention your 3 favorites. I want to hear what those are.
Okay. My 3 favorite, I'll go back and point them out. And then we'll go to the ROI calculator because that one. So the Forex Trading, the oil and gas, and the apartment syndications on this screen. So I'll do one more slide and then I'll go over to the ROI calculator, and I have those 3 in the calculator and I show how we look at stuff personally. So, you know, actually I'll keep this for when I pop over to the calculator. So if you invest 100K and you go into something that says, oh, it's an 8% cash flow, then what would that be on 100K? It would simply be 8K per year. And so that's the passive income you would get from that. But then also, if you look at a syndication or, you know, the oil and gas investments that we have at the exit, there's also a share in the profit at the exit. And so say in 5 years, the property is sold, the proceeds from sale over to investors, in this case would be 60K. And then you also get your principal returned when we exit the investment. So then if you take all the money, so the cash flow comes to 40K, the proceeds from sale come to 60K and your 100K returned to you, then you would have taken, if you add them all up, pretty simple math, you'd have taken your 100K and turned it into 200K over a 5-year period. And so if you divide that by 5, 100% divided by 5 is 20% per year. So that's where the 20% annualized number comes from. That's how it's calculated in the investment world. So it doesn't mean there's 20% cash flow, but it means if you annualize all the returns, it would come to 20% per year. And then also some investments have a, some sort of tax deferral element to them that will come across to investors in their annual tax documents in their K1. And so our investments all have around 30 to 100% of a tax write-off in year 1. depending on the investment. So that's always something you want to talk about as well when you're looking at investments, is how does it fit into your tax deferral strategy? So with that, I will pop over to the ROI calculator and we'll talk about that. Okay. Can you guys see the Excel spreadsheet on the front on the screen? Okay. All right, cool. I'll make it a little bit bigger though. Oh, is it going to let me zoom while I'm in Zoom? Strange. It's not letting me zoom in. Can you guys see the numbers okay? Or is it too small? It's kind of too small. This is
Go under the view menu. You can probably make it larger there.
From there. Okay. Thank you. Because it wasn't letting me from this little drop down for some reason. Okay. Is that better, you guys? Yeah. Okay, cool. All right. So this first one, so what we have in here, and I can share this all with you guys as well. I'll put it in the chat afterwards. But basically these are my 3 favorite. And we have it. Okay, so if I put some money in, what's going to happen over the next 3 years? So the first one is a syndication. The second one is Forex trading. And then the third one is the energy fund. So the blue is showing what the investment name is. The green is how much money you put in. So we can play around and put in different numbers and it changes the number. And then at the bottom, this will show what the combined portfolio will produce. And it's dependent on what you put in these green buckets. So that's how you use this. So the first one is a syndication. And so in this example, I put in 100,000 and say the syndication says it's a 6% cash flow per year, but it starts in year 2. And say 18% annualized return is the target. And we think it's going to be a 5-year hold. And we're going to do a cross seg, which I'm sure Scott has talked to you guys what that means. So there's going to be a 65% loss for you in year 1, which is a bonus for you for your taxes. So how does that work across the next 5 years for you? When do you get the money? So year 1 is negative 100K because you put 100K in this green box. The orange is the cash flow returns. So 6% per year, but it starts in year 2. Then there's an exit at the end of 5 years, and the blue is the capital gains you get from sale. So you get a profit of $66,000. You get a check for $66,000 at the end of year 5, and then you get your 100K back, your principal returned. So if you take a look at this one and you add all the money you've received, so the pink, the blue, and the principal return, you've made 190K, or you've made 90K on your 100K. And so we can play around. If you see an investment that it's a 20% annualized return, you can see how that yellow box turned into 200. I'm going to just set it back to 18 for now. And then let's say you also put in 100. I like 100 because it's easy to see the math, but maybe you put 50K in a Forex trading fund, or you're trading it yourself. And you think you can get 3% per month. So that would be 36% per year. And maybe some of it you won't take out and you'll reinvest. So maybe some months you get a little bit better. So let's say the annualized return is 40%. And say you're going to do the strategy for 3 years. And so what does it look like across the next 5 years? Well, you're going to only do it for 3 years. So, and this is just an example, you know. So you get $36,000. That's the pink cash flow. Then you take your money out and there's an extra 12K in there in addition to your 100K that you originally put in. And so in this case, your 100K would turn into 220K. Let's say you also want to put some money in an oil and gas fund. Not 20, but 200. And say the target cash on cash is 14%. Target equity multiple, we didn't talk about exactly what that means, but that means at the end of the exit, you know, so the example I showed earlier was a 2x equity multiple where your 100 turned into 200. Let's say this one is wanting to turn your 100 into 300. It's a 3x equity multiple. And it has a target hold period of 3 to 5 years. So let's think conservatively and say, all right, we'll say worst case, it's 5 years. And say the cash flow doesn't start in month 1, but there's a little lag. So in the first year, your cash flow is going to start a quarter in or something like that. So it's a little bit lower. And then you get $28,000 per year on this investment. So that's simply 14% of 200,000. You get that. And then at the exit, there's a profit sharing because of that 70-30 split or whatever it happens to be on the fund that you go into. And so you get a check for $267,000 of profit, and then you get your $200,000 returned. And so this 600K, this yellow, this is all the cash flow plus your principal return plus the profit that you've received. So you've turned your 200,000 into 600,000 over a 3-year period. Now this is not taking into account taxes you're paying or taxes you're saving, because that's going to depend on how you're holding your investment. So all of these you can hold with cash, with an LLC, with a trust, with a nonprofit. You can hold in your self-directed IRA, you can hold in your 401k. So know that those are all ways that you can hold all 3 of these investments. And so that's going to affect the tax situation, which is why it's not noted on here. But know for oil and gas that this yellow box, often there's a huge tax write-off in year 1 that can be used on your active income. So your AGI. So this real estate up here, this depreciation and loss on syndications and real estate, that can only be applied to your passive income bucket. But this oil and gas write-off can be applied to your active income bucket. So any returns you get from stocks, your W-2 income, any distributions you take from a business you might be running, your company. So know that that's a huge, huge advantage, 75%. So if you put in 200, you get 150K tax write-off.
And why is that, Sarah? Why that distinction?
Why the distinction between passive and active?
No, between the ability to take the deduction off your active income bucket on oil and gas. Yeah, why is that an option versus not kind of handled the same way as real estate?
Yeah, good question.
It's interesting, right?
Yeah, it is interesting. And I don't know why. I mean, those are the IRS rules. And it's not a choice of how we set up the fund. That's the IRS guidelines.
Sure.
I don't know why they made that distinction, but they did.
Cool.
So
okay, just nerd, thanks.
yeah, definitely. So I'll share this with you guys. So then you can play around. You can I would suggest if you play around with it, use the green box, and you can say, okay, I want nothing in Forex. That's too risky for me. I want to start with 50K from my IRA in a syndication, and I'm going to invest 100K cash so I can get a tax write-off. Use those green boxes, and then that comes to a total of 150 that you've invested, and the pink is how it would play out for you with cash flow. The blue is the profit you would receive, and then the yellow is the net, of what you've taken, your principal, what you've turned it into without taking the taxes into account. So I'll stop there and just say that's, I'll conclude the end of my content right there. I'll share this link with everyone. And I will ask, though, that you guys make a copy for yourself. So if you start playing with the green boxes, just make a copy for yourself. You can download it, whatever you want to do. And don't put any sensitive information in this one because we can all see it. All right, any questions?